The Madoff investment securities firm claimed steady annual returns of around 11%. This performance defied market logic during volatile periods. The firm attracted pension funds, charities, and sophisticated institutional investors. Many investors never questioned how the returns were generated. Understanding why requires examining the psychology of trust itself. First, let's discuss authority signals that fraudsters exploit. Bernard Madoff built credibility through legitimate Wall Street credentials. He served as chairman of the Nasdaq Stock Exchange. This position provided an aura of institutional legitimacy. People assumed regulatory bodies had already verified his operation. Second, social proof created a dangerous feedback loop. When prestigious institutions invested, others followed blindly. Famous charities and universities parked billions with him. The logic became, these organizations have resources to investigate. If they trusted him, individual investors felt safe. Third, the incentive structure rewarded silence and complicity. Financial advisors who referred clients earned substantial fees. These advisors had personal wealth tied to the scheme. Questioning the investment threatened their own income streams. Fourth, complexity obscured the underlying mechanics. Madoff claimed to use a split-strike conversion strategy. Most investors lacked the sophistication to evaluate this claim. The technical explanation served as a shield against scrutiny. Fifth, consistency created false predictability. Steady returns month after month felt reassuring. Volatility felt dangerous even when it was normal. Investors had been conditioned to expect the impossible. The scheme exploited a fundamental human bias toward stability. People prefer reliable mediocrity over unpredictable excellence. Now let's examine how this pattern repeats across industries. Multi-level marketing companies use similar trust signal mechanics. They recruit celebrity ambassadors to build credibility. Company events create tribal belonging that discourages skepticism. Participants see friends succeeding and assume the system works. The warning signs were present throughout the Madoff operation. Returns remained consistent regardless of market conditions. This violates basic principles of investment theory. Legitimate managers experience drawdowns during crashes. Madoff claimed to use an options strategy that limited losses. This explanation should have raised immediate questions. Options strategies cannot eliminate market correlation entirely. The firm operated from a tiny office in Manhattan. Large hedge funds typically maintain sophisticated trading operations. A multi-billion-dollar fund needs infrastructure and staff. Madoff's operation appeared deliberately opaque to outsiders. He refused to allow independent audits of his methods. This secrecy was framed as protecting proprietary strategies. Regulators failed to investigate despite multiple red flags. A former SEC employee raised concerns years before collapse. These warnings were dismissed without proper investigation. The SEC conducted examinations but missed obvious inconsistencies. Why did intelligent people ignore these warning signs? Greed clouded judgment about risk and legitimacy. The desire to believe overrode analytical skepticism. Social pressure discouraged independent thinking. Admitting doubt meant admitting potential loss. Cognitive dissonance kept investors committed to their beliefs. They rationalized inconsistencies rather than confronting reality. The scheme lasted so long that doubt became uncomfortable. Now let's identify universal warning signs across fraud types. Promises of steady returns with no risk represent a red flag. All investments carry inherent uncertainty. Difficulty understanding how money is made suggests obfuscation. Legitimate investments can be explained simply. Resistance to independent verification indicates hidden problems. Reputable firms welcome transparency and audits. Exclusive access creates artificial urgency and scarcity. Legitimate opportunities don't require immediate commitment. When everyone you know is investing, question the herd mentality. Success of others doesn't validate the underlying model. Pressure to recruit others suggests pyramid structure problems. Sustainable businesses profit from product sales, not recruitment. Lack of registered credentials or regulatory compliance matters. Verify licenses and registrations independently. Testimonials replace evidence when products lack substance. Real performance can be documented with transparent data. The pattern across all scams shares common elements. Fraudsters exploit trust through authority and social proof. They create incentive structures that silence dissent. Complexity hides mechanisms from casual examination. Consistency substitutes for legitimacy in investor minds. Regulatory oversight often fails to catch sophisticated operations. Understanding these mechanics helps protect against manipulation. Knowledge becomes armor against psychological exploitation. Critical thinking requires questioning even trusted sources. Diversification and verification provide structural protection. No single investment should represent concentrated risk. Independent research supplements rather than replaces professional advice. Professionals who discourage questioning operate suspiciously. Transparent advisors welcome due diligence from clients. The Madoff case changed how institutional investors conduct oversight. Modern compliance requires more rigorous verification procedures. However, fraudsters continuously adapt their methods. New platforms create fresh opportunities for trust exploitation. Digital currencies and online investments require heightened scrutiny. The fundamental psychology of trust remains unchanged. Humans seek authority, consistency, and social validation. Scammers weaponize these instincts for personal gain. Recognizing manipulation patterns protects your resources. Education about fraud mechanics creates collective resistance. Sharing knowledge builds community resilience against exploitation. Understanding why people fall for scams reduces stigma. Victims deserve empathy rather than judgment. Fraudsters specifically target vulnerable populations. Economic desperation increases susceptibility to promises. Financial literacy provides structural protection against manipulation. Schools rarely teach critical evaluation of investment claims. This knowledge gap creates exploitable vulnerabilities. Supporting financial education strengthens community defenses. The most profitable scams succeed because we want to believe. Believing feels better than questioning. Comfortable lies outcompete uncomfortable truths. Developing comfort with uncertainty protects against manipulation. Not every opportunity requires immediate commitment. Patience and skepticism guard against exploitation. The next time an opportunity seems too good to be true, examine the trust signals being deployed. Ask who benefits from your belief rather than your analysis. The most valuable skill in modern finance is distinguishing signal from manipulation. Follow for more business stories and hidden money systems.